Have you ever wondered about the debt-to-equity ratio and why it's so important? Well, it's not just a fancy term that financial analysts throw around. It's a critical measure used in the world of finance to assess the financial health of a company. Imagine it as a scale balancing the money a company owes, known as debt, on one side, and the shareholders' equity, which is the value of the ownership interest in the company, on the other. A proper balance between these two elements is crucial for the stability and growth of a company. But what makes this ratio so important? How can it help us understand a company's financial standing? And what does it mean when this ratio is too high or too low? These are the questions we'll be exploring as we dive deeper into this topic. So stay with us as we dive deeper into the concept of the debt-to-equity ratio. To begin with, what exactly is the debt-to-equity ratio? Well, in the world of finance, this ratio is a key metric that investors use to gauge the financial health of a company. It is a financial ratio that compares a company's total debt to its total equity. To put it simply, the debt-to-equity ratio is a method of measuring the relative proportion of the company's shareholders' equity and debt used to finance its assets. It's a way for us to examine how a company is leveraging itself, and it shows the balance between the money a company owes and the money it has on hand. The formula for calculating this ratio is quite straightforward. You take the total liabilities of the company and divide it by the shareholders' equity. The result you get is the debt-to-equity ratio. But why is this ratio so important? It's because it gives us a snapshot of a company's financial leverage. A high debt-to-equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in volatile earnings as a result of the additional interest expense. On the other hand, a low debt-to-equity ratio might indicate that a company isn't taking advantage of the increased profits that financial leverage could potentially bring. Now, it's essential to remember that what's considered a high or low ratio can greatly depend on the industry. Some industries, like financial services or utilities, tend to have higher debt-to-equity ratios because they can handle higher amounts of debt. Conversely, personal service or IT firms usually have lower ratios because they require less capital. In essence, the debt-to-equity ratio is a tool that helps us understand the balance between the risk and return of a company's capital structure. It's a snapshot of a company's financial leverage at a given point in time. Now that we have understood what debt-to-equity ratio is, let's understand how it works. So how does the debt-to-equity ratio work? Well, imagine a company as a pie, divided into two slices. One slice represents the company's total liabilities or debt. This includes loans, accounts payable, and any other obligations the company has to pay. The other slice represents shareholder equity, which is the value of the company's assets after all debts have been paid. The debt-to-equity ratio is simply the size of the debt slice compared to the equity slice. It's calculated by dividing the company's total liabilities by its shareholder equity. The result is a number that shows how much debt the company is using to finance its assets compared to what it owns outright. Let's illustrate this with a simple example. Suppose we have a company, let's call it Company A. Company A has total liabilities of $2 million and shareholder equity of $1 million. If we divide the total liabilities by the shareholder equity, we get a debt-to-equity ratio of 2-to-1. This means for every dollar of equity, Company A has $2 of debt. Now, you might be thinking, that sounds like a lot of debt. But remember, debt isn't necessarily a bad thing for a company. In fact, many companies strategically use debt to grow and expand. The key is to maintain a balance between debt and equity that allows the company to meet its financial obligations while also investing in future growth. However, a high debt-to-equity ratio can also indicate financial risk. If a company has significantly more debt than equity, it may struggle to pay off its debts, especially if its income decreases or interest rates rise. That's why investors and financial analysts closely watch the debt-to-equity ratio. It provides a snapshot of a company's financial health and risk level. Understanding the workings of the debt-to-equity ratio is crucial, but what does it mean for a company? Let's now interpret what the debt-to-equity ratio really signifies. In the world of finance, numbers speak. They tell tales of profit and loss, risk and reward. And among these numbers, the debt-to-equity ratio holds a distinctive place. It gives us a glimpse into a company's financial structure, revealing how it balances debt against its equity. So, what does a high debt-to-equity ratio indicate? Simply put, a high ratio is a signal that a company is funding its operations, its growth, its ambitions with a greater proportion of debt. It's like a friend who's always borrowing money to fund their lifestyle, eventually owing more than they own. This might not necessarily be bad. It could mean that the company is leveraging debt to fuel growth, to seize opportunities, but it could also be a sign of over-reliance on borrowed money, a potential red flag for investors. The debt-to-equity ratio, like any financial metric, has its pros and cons. Let's delve into them, shall we? One significant advantage of the debt-to-equity ratio lies in its ability to provide a snapshot of a company's leverage. By comparing the proportion of debt to equity, it gives us insight into how a company finances its operations. The higher the ratio, the more the company relies on borrowed money, which can be a red flag for investors. Another pro is that it aids in assessing risk. A lower debt-to-equity ratio often indicates a more financially stable business, less reliant on debt to fuel growth. This can be a reassuring sign for investors, as it suggests the company has a safety cushion in times of financial turbulence. However, it's important to remember that this ratio varies across industries. A high ratio may be the norm in capital-intensive industries like utilities or real estate, while it may signal trouble in other sectors. So it's crucial to compare companies within the same industry to make a fair assessment. Now let's turn the coin and look at the cons. The major downside of the debt-to-equity ratio is that it doesn't provide a comprehensive view of a company's financial health. It only considers debt and equity, leaving out other liabilities like accounts payable or pension obligations. This can result in a misleadingly rosy picture. Another disadvantage is that it doesn't take into account the cost of debt. Two companies may have the same ratio, but if one has high interest debt, it could be in a more precarious financial position. So while the debt-to-equity ratio can give an initial idea of a company's leverage and risk, it shouldn't be the sole determinant in investment decisions. So, the debt-to-equity ratio is a useful tool, but it should be used in conjunction with other metrics for a fuller picture. It's like a piece of a puzzle, necessary, yes, but incomplete on its own. Always remember, in the world of finance, context is key. Let's take a moment to recap what we've learned about the debt-to-equity ratio. This financial metric is a key tool to understand a company's financial health. It's calculated by dividing a company's total liabilities by its shareholder equity. The result gives us an idea of how much debt a company has relative to its equity, allowing us to assess its financial leverage. Remember, a high debt-to-equity ratio can indicate that a company is using debt to finance its growth, which can be risky. On the other hand, a low ratio may suggest the company is not taking full advantage of the benefits of debt financing. But it's crucial to remember that this ratio isn't a standalone indicator. It should be used in conjunction with other financial metrics to provide a comprehensive picture of a company's financial situation. And with that, we conclude our discussion on the debt-to-equity ratio. Remember, it's a valuable tool, but not the only one in your financial toolbox.